So we took his new share because it was reinvesting while it's down, and he does it, and I see him clear the calculator. And I'm like, man, he must have fat fingered it or did something wrong. So he did it again. I was watching him do it. He had the calculator. I wasn't even doing it. Then he hit it again. He was like, I saw him do this. And I looked at the number and I was like, did you clear that because you didn't believe it? And he was like, yep. And he was like, that does not make sense. That's what compounding dividends do. That's what I would call dividend math.
Yep.
Dividend math is like wacko. It doesn't make sense. It makes your brain hurt because you can have less per share price and have more value.
Welcome to Planning Made Simple. Today we've got a really interesting topic. We're going to talk about dividends, and your normal host was a little bit shy. He thought he might get caught off guard by this one. So you wanted me to kick it off. So no, Paul might be our resident guru on dividend income.
I don't know. I think we all are, but it's just a fun topic to discuss. So what are we talking about today? The dividend gap? What's that?
Yeah. I'm still puzzled by why we're calling it a gap, but you were trying to help me out with it.
In my opinion, the gap that we're going to be talking about today is
this is the framing of how we're going
to be talking about the gap between what is true, like the reality, versus what we want to believe or what we think is true. The myth aspect of reality when it comes to dividends versus growth.
Gotcha.
Or
so
growth versus income.
So when things aren't all rosy and it's all green, when we're looking at your account, you open up Schwab or whoever your custodian is, and you see some of that red, you really feel like things are falling apart.
But like with the war, or any war, or a big market correction.
Tweets.
Tweet, political, whatever, elections.
Yeah.
You name the issue, and all of a sudden we see red in our account and our statement, and things get bad instantly. Is that really controlling what you depend on for retirement income? Or is that just
noise on your account balance?
Yes. So this is the gap. The gap is what is actually happening in that situation where things get really bad and how much panic needs to set in. What needs to change? Things like that. So the gap is what's really happening. And how should you or should anybody respond?
Yeah. How many deep breaths you got to take, Cal?
That's right.
And before we jump in, anxiety is a real thing.
Oh, no one likes looking at their account and seeing a bunch of red.
And I don't want to blow over the fact that a loss is real. Even on paper, there's those people that it's just the loss on paper. Or you look at the startups, name the startup, and there's like, well, they've never made money. I mean, how long was Netflix unprofitable? I mean, it was unbelievable.
Might still be.
Yeah, I don't even know. We don't own it. But there's reality of anxiety and understanding how it really does affect you. So we're going to be talking about some real things, but I don't want to sidestep the fact that we're not just ignoring somebody's feelings.
Right.
And being like, oh, don't worry about it. It's no big deal. There's a lot of empathy.
Yeah, the heart is there.
Yeah.
Like we understand what you're saying. It is your, like for a lot of people, that is your retirement. That's all the money you've worked so hard to save.
Well, and we eat our own cooking, as Nikki says. We are a product of what we preach. Like I only own what is in our portfolio, in my portfolio. So, at the end of the day, I feel the same thing that our clients do.
Sure.
So I just wanted to make a note on that. We're not gonna sit here the whole show, and Nikki's not here today to sit there.
That's right.
But we're still gonna make fun of her for it.
And since she's not here, don't forget to subscribe. So I got to take her spot.
Awesome, love it. So let's talk about the problem. Who wants to frame up the problem?
Well, I think a lot of times as investors, you do see there's a shift in the market, there's a shift in your value. And you immediately think, how is this going to affect my income?
Yep.
Does it go down with it? And in some cases, depending on how you're invested, it can, because you have less value to then sell and take as income.
Well, how do we believe it works?
But
you have $100 share.
And if it drops to 80 and my income was, whatever, it drops as well.
Yeah. So the reality is this is how we all think. If I have $10,000, $100,000 in my account, and I'm $100,000, just use that, and I'm making $5,000 a year of income on that $100,000, and it drops to 80. Does that 5 go to 4? Yes. Most of us go, well, if I'm withdrawing 5% and that income or that value drops, my income drops along with it. With growth stocks, is that true? Yeah.
With growth stocks,
Yes.
yes, absolutely. Yeah.
With
Especially if
dividend
that's your
stocks,
drawdown.
is that true?
No, because you're getting paid off of the number of shares you own, not the value of your account.
So let's rewind that and explain how that works. So if you have $100,000 in a dividend, one dividend stock,
Yep.
and it's paying 5%, is it 5% of the value? What is that? Where's that 5% come from? Because this is the myth part.
That's the current yield, their payout, the company's payout, which is a cash dollar amount.
So it's a dollar amount, not a percentage.
Correct. And then that dollar amount or your actual dividend is based on the number of shares you
Per
own.
share.
Per share. So you have a dividend rate,
Yes.
which is a dollar amount, and then you have a dividend yield, which is a percentage of the dollar amount as it relates to the dollar value.
Correct. So
Yep.
as the value of your stock goes down, that percentage actually moves up. It moves opposite.
Because the dollar amount is specific and steady.
Correct.
So until that dollar amount changes, your income does not.
Correct.
Correct.
So if it's $4 a share and it's paying you $5,000 a year based on how many shares you have, no matter what happens to that price, you get $5,000.
As long as you don't get rid of any shares. Yes.
So the answer is yes.
Yes.
I'm looking for finite answers today.
Yeah.
I don't want to be that guy that's like, probably.
No.
Maybe.
Yeah, maybe. Assuming nothing else.
Depending.
No, if you have a set amount of shares paying a set dollar
Yes.
amount, unless either of those things change, you get the same number.
Correct.
And it is or is not attached to the value. That's where it gets confusing.
Yes.
It is the share price times how many shares you are is that dollar amount, the value,
Yes.
not your income. So there's two things at play here. You have a share price, which is a ticker. It changes every second.
Mm-hmm.
It's most frustrating. Those are those day traders like looking for that blip.
Make
you know?
a couple pennies.
Yeah. But with a lot of shares, you can make a lot of money.
Correct.
So you have a share price and you have how many shares you own. Those two numbers equal your value. Take the share price out of the equation for income. The share price doesn't matter at all. You have the same number of shares. Now you multiply this times the dividend rate, which is a dollar amount. And that is a set number of shares and a set number or set dollar amount dividend. And that calculates your income. So you have one calculation for your income and another calculation for your value, which controls your yield. That's where there's a confusion.
Mm-hmm.
The problem is you get two completely different calculations for two completely different things, but in our mind, we're like, they're the same.
We attach them.
Mhm.
Yeah. Well, my value controls my income. No, it doesn't. It could, but not with dividend investing.
Right.
And that's where the maybe comes in. If you're a growth investor and you're 100% counting on the market fluctuation, anxiety is real. It's a concern, and there's nothing you can do about it unless you go into some fixed security or something like that. With dividends, craziness can ensue. Market volatility, and your income can actually go up. And that's, I think, the clarity part. Let's jump to that.
Yep.
So let's talk about how market volatility, and when I'm saying market volatility, I'm not talking about like going up. I'm talking market volatility like scaring you to death.
Yeah. Riding the roller coaster.
Yeah, it's going down.
Yeah.
Okay, so we're dropping 10, 20, 30% in the market. How could that be a good thing for a dividend investor?
Well, it's extremely good if you're in that reinvestment accumulation phase, or if you have a surplus even from what you're living on in retirement. Because when the value drops and you're still getting paid your $5 per share, guess what happens? Everything just went on sale. So you're actually able to go and accumulate more shares, which then drives up your income even more than if you were buying it at that $100 per share.
So I had a client in my office last week, might have been last week or the week before, and he's a newer client, and I was trying to help him understand everything. And he sits down in my office right away when we first got in, and I was like, "How you doing?" And he said out loud what probably everybody's thinking about dividend investing, because I'm just here to make sure that this is real. and that was he's a client, he's a newer client. But he hasn't been battle tested,
Yeah.
and he said probably the most honest thing I've heard in a long time from somebody. He's scared and he's just wanting to understand. So I went into some education and, I pulled up his Schwab account and we looked at, and he's so new, he had only had like a half a dozen stocks pay dividends. So he was trying to understand the whole concept. And I was like, okay, pick a stock. I didn't even cherry pick. I was like, just pick a stock on here. And he picked a stock and I was like, how many shares do you have? And we looked at the amount of shares that he had. So then we went to the Yahoo Finance or Dividend Investor or whatever. And we're like, what's the dividend yield? So what's the dollar amount it pays? How many shares? We looked on his website at Schwab. How many shares? It has this many shares times this many. And then we calculated out. Then we went back to Schwab and it estimates the dividend. And those numbers lined up. And I was like, let's talk about volatility. So I looked at the 52-week trading range. And this stock had fluctuated over 40% because it was an oil and gas stock. And the Iran war over the last year has made gas prices wacko. So I was like, okay, let's just say you're the worst investor of all time and you bought it at this price, the top price, the 52 weeks. And now it's at the bottom. And it was like $90, the stock he picked. And the stock is trading at like 150. I think it was trading at 150 and it was 190 was the peak and 101 was the low part in the last year. I mean, that's a massive trading
That's a swing.
So I was like, all right, let's just say we bought it at the absolute worst time. The exact dollar amount of the highest of the last year times the shares. Write that down. He writes it down. So let's just say today it's at the lowest point. And this is 1 year after investing with me, or whatever. It's down here. And the gap was wide. And he wrote the number down. So he had his high point and his low point. And I was like, let's just say it stays low for a couple years. And every year, you're like, why are we holding this? And you're mad at me because it's just sitting down here. And we know some clients out there, myself included, where you're like a little testy after a while going, why are we holding this? It continues to sit in the trough. It's a toilet stock. Can we just get rid of it? Now, this is a good company getting wrapped up in a situation it has nothing to do with. It's bringing its stock down. Sometimes what happens to a stock has nothing to do with what the company's actually doing. Amazon's a great example of what happened in the bubble burst. They were building something incredible. They weren't making any money. Actually, they were making money.
They were making
and the stock was getting crushed. It lost like 90% of its value. Nobody thought it was going to survive. One of the largest companies in the world now. So sometimes what the market says is happening and what's reality, two different things. So we left it down there for a couple years. We calculated how many reinvesting that dollar amount. We looked at its history. It has a long-standing history of not only paying its dividend, but raising its dividend. So we did a little bit of math together. He did some calculations, leaving it down there for a couple years. And I said, okay, pick a number between 101 and 190. He picked 150 or 150 something. So we took his new share because it was reinvesting while it's down. He took his new share, multiplied by that 150 something, and he does it. And I see him clear the calculator. And I'm like, man, he must have fat fingered it or did something wrong. So he did it again. I was watching him do it. He had the calculator. I wasn't even doing it. I had no idea. He picked the stock. He picked all the numbers. So I had no idea what was going to come out. And then he hit it again. He was like, I saw him do this. And I looked at the number and I was like, did you clear that because you didn't believe it? And he was like, yep. And he was like, that does not make sense. We bought at 190. The stock came down to 101. He reinvested all the extra shares at that 101 for a couple years. And the amount of shares had grown significantly at that lower rate. And then when he was recalculating more shares at a lower price than what he actually bought it, the value was higher. So let me explain that. He had more shares at a cheaper price, and the value was more than what he actually started with. It had $40 to get back to where the starting price was, and yet he had more value. That's what compounding dividends do. That's what I would call dividend math. Dividend math is like wacko. It doesn't make sense. It makes your brain hurt because you can have less per share price and have more value. So when you have a good company that shows red in your portfolio, it's the best situation possible. Because now you have a company that's a rock star, that's doing all the right things. Their price is just down for whatever reason.
something that's out of their control.
And we've got a couple stocks in our portfolio that have been horrible for the last couple of years that are barn burners this year for this exact principle.
Yep.
We were buying a ton of shares cheap. We were rebalancing, buying more shares cheap. We leaped forward. The stock's not even back to where it was, and our values are way ahead.
Yes. It's not even close to.
So what I'm actually talking about is happening or has happened many times over in our clients' portfolios, and they don't even realize it.
Right.
So a depressed value, when you see market volatility, what we believe to be true and what is actually true are totally different. Over to almost to the point we have to reset the calculator to do it again because we're like, there's no way that how could we be $40 less per share and actually have more value? And it was like significantly more value.
Well, that's just a good reminder, a good reset for all of us, because when you do feel that real emotion, you have to take that extra second and remember that they're detached. Though they are together, dividend and value and all these things, how your income is derived is very different than what that share price is.
Correct.
And you have to remember that.
Any last thoughts before we shut this down? I've got one.
Go for it.
Any client that's out there that hasn't, or clients of mine or your clients that hasn't walked through the exercise that I went through with my client, set an appointment.
Please.
Like go, hey, I want to understand this better. And we call it an onboarding. It's where you can get a much deeper understanding of how dividends work personal to you, like your stocks, your shares, that math. So you can understand firsthand what's in your portfolio and how it affects you. So you can actually grab a calculator and run across the street and statements and go, okay, this is what I can expect. Not just hope the statements are right, but literally know how to calculate it. It'll change everything. And it was so impactful for him. We've been doing this for a long time, but we haven't done it with everybody. And this is, if you haven't had that experience, call the office, set up an appointment, and let's go through that.
Please.
So, any last call
awesome.
out?
No, subscribe. We've got more for you, and we look forward to seeing you soon.
God bless. Thanks for watching Planning Made Simple. Every week, we bring you conversations that are entertaining, educational, and focused on making life's big decisions a little simpler. Make sure you subscribe for our best content each week, and we'll see you next time.